Financial markets have been in correction mode since the start of May, led by commodities. Silver is down from close to $50 to around $33, a more than 30% drop. Oil has dropped almost $20 from close to $115 to around $97 a barrel. Copper is down about 60 cents from its mid-February high to around $4 a pound. And as a result, the commodity stocks, which led the most recent leg of the bull market from last September, have led the market on the downside the last 2.5 weeks. You can look at this based on a chart included in my client note, The Limits of a Commodity-Led Stock Market, where you can clearly see energy was up 50% through that point since September 1st. And now the most recent chart included with this client note, you can see that energy is down about 9% thus far in May. Now there are a number of different views about what this means. Some people think this is a buying opportunity in commodities and commodity stocks. The global growth story is still alive. Nothing has changed. This is a technical correction. This is a buying opportunity. Steve Cohen, the famous hedge fund manager of SAC Capital, appears to be in this camp. The most popular view is that this represents a leadership rotation from commodity and energy and commodity stocks into stuff like consumer discretionary, industrials, technology, and other sectors that benefit from lower commodity prices. These sectors will take the baton from commodities and lead the next leg of the bull market. David Bianco, Chief U.S. Equity Strategist at BofA Merrill Lynch, expressed this view succinctly on CNBC's Closing Bell last Wednesday. Kramer has this view, as does Thomas Lee, Chief U.S. Equity Strategist at JP Morgan. Now, finally, there is a camp that believes that the commodities correction is the start of a larger stock market correction. At the same time that commodities have been selling off, the dollar has been rallying quite strongly. The dollar index is up 3.5% since the start of May, and the dollar is up 7 cents, about 5% against the euro over the same time period. Now, the dollar, playing the role that it does in the global currency system, is a very true barometer of risk-taking and risk aversion. When you see the dollar selling off and other and commodities and other currencies getting stronger against the dollar, that's a sign of risk appetite. Conversely, when the dollar is rallying and other currencies are falling against it, as are commodities, that's a sign of risk aversion. Altogether, the market action suggests to me that market players are rating in risk. And it's surely no coincidence that this coincides with the coming end of QE2 at the end of June.